Most investors can remember a stock market crash. They're no fun, and because bull markets don't last forever, some investors live in fear of the next one. In this series of videos, we're going to show you how fearing market downturns is a waste of time and energy that leaves investors with lower returns. We'll be giving you 5 compelling reasons why, if you invest the right way, they simply aren't worth worrying about. In short, we're going to show you how to conquer your fear of crashes and corrections. This game behind me is one of my favourites. It's called JENGA. Players take it in turns, removing one piece at a time from a tower constructed of small wooden blocks. Each block removed is then placed on top of the tower, creating a progressively taller and more unstable structure. The game ends when the tower falls. The winner is the last person to remove and place a block successfully. It's a great analogy for the stock market. At some stage we know the tower is going to fall and nobody wants to lose. The stock market will inevitably crash from time to time, but nobody knows when.
It's very popular to ask investment experts how to predict or whether they can predict declines in the market. It's a very difficult thing to do. What we can predict is volatility. When markets become volatile and start moving up and down, then after a period of volatility, which might be when the market has jumped up or might be after the market has declined, the likelihood of an extreme move is amplified. So in that sense, we can predict when a market is more likely to fall, but it's also going to be more likely to increase in value.
Throughout evolutionary history, human beings have thrived because of our ability to spot patterns. For example, we worked out how the seasons work and how to use those seasons to grow and store crops efficiently. But discerning patterns in the stock market is deceptively difficult.
It looks easy in hindsight when you look at crashes, stock market bubbles. In hindsight, you think it would have been very easy to know when to buy and when to sell. But the reality is, at the time when things are happening, you often don't have the full information sets. You're embroiled in many sorts of emotions, which would then lead you astray and not contribute to proper, reasonable decision making.
But surely we can have a rough idea as to whether a particular market is overvalued or not. After all, we can spot items in the shops which seem more expensive than they should be. Unfortunately, though, it's not that simple.
In the short term, it is entirely impossible to predict when markets are about to fall. Markets are volatile. They swing up and down over time, but they're not completely random. They're not random in the sense that market prices are effectively backed up by companies' profits. We cannot predict the profitability of companies, and for that reason we cannot predict the stock price with any degree of accuracy. Over very long time periods, however, there is some degree of predictability. But even that means we are only able to say that, well, compared to historic averages, stock markets are either high or low and are more likely to fall or rise, but we still cannot pinpoint the exact moment at which stock markets are about to fall.
People can look at patterns of prices, people can look at what other people are thinking, but it's very, very difficult in the short term to know whether markets are going up or down. The problem is, you can say a PE ratio, for example, a price-earnings ratio, which is the multiple of the price to the earnings per share. You know, you can say the market average is 15, if it's 10 it's cheap, if it's 20 it's expensive. But companies play around with their earnings. You can define earnings in different ways. Different countries have different ways of accounting for earnings. So actually it's not quite as easy as that.
The fact that predicting market crashes is extremely difficult doesn't stop people trying. bull markets can last for many years, and yet self-styled experts regularly warn that stock prices are about to collapse. In almost every case, the crash doesn't materialise, and investors who heeded the warning can miss out on substantial returns. And of course, when the market does eventually crash, most of the experts are taken by surprise.
Very few of these pundits have any track record in actually having been able to pinpoint when exactly markets are about to fall. And it's also important to realize there are thousands and thousands of these people. There's financial analysts, there's professional economists, there's just journalists in the press. And it just takes for one of them to be right once in order for people to say, well, he or she is able to predict when markets are about to fall. You don't hear about the other thousands and thousands who have been wrong again and again.
Nobody foresaw the 2008 crash, or very few people foresaw it. And in 1987, when I was working in the city, this guy made a fortune having bought put options on this S&P, which is the American index. And it turned out he'd just got his letters wrong, and he'd been actually trying to buy puts in something else. And he went on to have a very well-paid career in the city because people thought that he'd seen the market coming. So I'm afraid I'm a bit cynical about that.
So if even the professionals can't predict a crash with any accuracy, why fool yourself into thinking that you can? Crashes will happen, but no one knows when. What's the point of worrying if you can't do anything about it?